Welcome to the Deep Dive, where your shortcut to understanding the energy market's biggest moves. Today, it's all GE Vernova GEV. We're digging into their huge Q3 2025 results, the reaffirmed guidance, and this major strategic announcement about Prolec GE.
Yeah, and this wasn't just a decent quarter. It really showed financial muscle. GEV's clearly operating from a position of strength now, and that's what's fueling this accelerating growth. It all links back to this huge need for more electricity, more grid investment.
Okay, let's get straight into those Q3 numbers then. Execution looked really strong. Total orders, they just exploded. $14.6 billion. That's what, a 55% organic jump year over year?
Massive jump, yeah. Driven mostly by equipment, especially in power and electrification. And revenue was solid, too. $10 billion, which is 10% organic growth. Pretty healthy.
Healthy revenue, but the profitability, that seemed like the bigger story. Adjusted EBITDA.
Exactly. $811 million there. And the crucial part, the margin hit 8.1%. That's a 600 basis point organic expansion, which basically means they're getting much, much better at turning those sales dollars into actual profit.
Right. Profit's one thing, but cash flow, liquidity, that foundation for what's next, how did that look? That's where you see the real confidence.
Yeah, good point. Free cash flow was positive, $207 billion for the quarter alone. And that's feeding right back into the business. The total backlog, future committed work grew again, sequentially up $6.6 billion.
So the total backlog is now over $135 billion.
Well over.
Yeah.
And that gives them, real visibility for years ahead, especially on the equipment side.
That equipment backlog must be pretty substantial now.
It is. It grew $11 billion just this year to date, hit $54 billion.
Yeah.
So look, the demand they're seeing, it's sticking around. And even with all this, they've been disciplined. Turned $2.4 billion to shareholders so far this year, but they're still sitting on almost $8 billion in cash.
Okay, and that cash gives them options like the big acquisition we'll get to.
Precisely. It gives them that dry powder.
And this strong performance, it let them reaffirm the full year 2025 guidance pretty confidently, trending towards the high end of that $36 to $37 billion revenue range.
That's right. Keeping the adjusted EBITDA margin solid at 8% to 9%, and free cash flow staying strong. $3.5 billion projected.
Any nuances in that guidance? Anything to watch?
Well, one important detail was about the tariffs, the external cost pressures. They're saying the impact is actually trending toward the lower end of that $300 to $400 million range they guided. That's net of mitigation.
Oh, okay. So they're managing those headwinds effectively.
Seems like it, yeah. Showed good execution.
All right, so strong financials, strong outlook. That sets the stage perfectly for the big strategic news. The Prolec GE deal. This is the centerpiece, right? GEV buying out the remaining 50% of the Prolec GE joint venture from their partner, Xignux.
Yep. They've been partners for 30 years in this transformer business. Now, GEV wants full control.
And this is all about boosting electrification.
Absolutely. It's GEV hitting the gas pedal on that segment, really targeting the fastest growing part of the whole grid build-out. So the deal mechanics. It's a hefty price tag, $5.275 billion. They're funding it half with debt, half with that cash on hand we just talked about.
Yeah, okay.
Expected to close around mid-2026.
Yeah.
And Prolec itself, it's a world-class transformer business, really focused on North America, utilities, industrials, and importantly, those big new customers like data centers.
Okay, $5.275 billion for half the company. That feels like a really big number. Is there a risk they're overpaying just to get capacity in a really hot market right now?
That's fair, yeah. The valuation is definitely rich. But you have to look at Prolec's profitability. It's expected to pull in $3 billion in revenue this year with really strong EBITDA margins, around 25%.
25%? Wow.
Exactly. So it's immediately margin-accretive to GEV's overall business, even before you count any synergies.
Yeah.
So yes, it's a premium, but they're buying very profitable, very necessary growth in a critical area.
And Prolec's own growth forecast is pretty strong, even standalone.
Oh, yeah. They project revenue going from $3 billion this year to over $4.2 billion by 2028. EBITDA crossing $1.1 billion. And that's based on an existing equipment backlog of around $4 billion, plus capacity investments they've already put in place.
So if the JV was already doing so well, why spend over $5 billion to buy out the partner? What was the absolute key strategic driver here?
The biggest single thing, honestly, it removes a major commercial handcuff. Under the old JV agreement, there was a non-compete clause. It actually restricted GEV from selling certain transformers directly into North America.
Wait, really? So GEV couldn't fully compete in its own backyard for transformers?
For 30 years in certain key areas, yeah. So this deal fundamentally is about GEV buying back the right to compete fully in its biggest, most important market. That's huge.
That really reframes the deal. It's not just buying assets, it's buying market access.
Exactly. Full ownership lets them use their entire global factory network to serve North America better, improve lead times, streamline things for customers. The market context here is key too. This whole move accelerates their play in what they call the North American serviceable addressable market, basically. Everything they can sell into combining electrification systems and now Prolec. They expect that market to pretty much double by 2030. That's like a 10% compound growth rate every year. They want all of that potential.
And are they getting new product capabilities out of this too?
Definitely expanding the portfolio.
Yeah.
Prolec has good tech in low and medium voltage transformers. GEV now thinks they can take that tech and sell it globally, outside North America. That's potential revenue upside they haven't even built into the main forecast yet.
Interesting.
Plus, they get the ability to make those really critical HVDC high-voltage direct current transformers locally in North America. That's vital for connecting big renewable projects and strengthening the grid.
Okay, so they bought a high-performing asset. What about making it even better? Synergies, operational improvements?
Right. Since Prolec is already running at high margins, it's less about fixing problems and more about maximizing what's already good, applying GEV's lean manufacturing principles.
So what kind of cost savings are they actually targeting?
They're aiming for annualized cost synergies between $60 million and $120 million by 2028. And it's practical stuff. Using GEV's global buying power for materials, standardizing some transformer designs, optimizing R&D, maybe some G&A savings. Pretty standard integration playbook.
With all this demand everyone's talking about, capacity is always the worry. Is Prolec actually equipped to handle the growth GEV expects through 2028? Or will they need massive new investment?
Management was pretty clear on this. They said they do not feel capacity constrained for those 2028 targets. Prolec actually invested about $300 million already in expanding capacity across its 7 sites. 5 are in the U.S., plus that key plant in Mexico that's USMCA compliant.
So they planned ahead.
Seems like it. Those investments should cover the projected growth without needing another huge slug of CapEx right away.
And looking beyond cost savings, where's the potential revenue upside from integrating Prolec more deeply?
Well, one big area is linking Prolec's transformers with GEV's grid automation business. So adding digital monitoring, performance management, that sort of thing, making the hardware smarter. And then, as we mentioned, building those complex HVDC transformers locally. That's a big potential market tied directly to the energy transition investment ways.
All right, let's quickly run through how the main business segments actually performed in Q3. Starting with power, how did that hold up? Looked pretty solid.
Power was very resilient, yeah. Orders up 50% organically, revenue grew 14% organically, and the EBITDA margin expanded nicely to 13.3%. A lot of that strength comes from the gas turbine side. They signed contracts for 12 gigawatts of new capacity in Q3. That's 1 gigawatt in firm orders, plus 11 gigawatt in slot reservations.
And those slot reservations, those are basically customers paying to hold a spot in the production line, right? Almost guaranteed future orders.
Pretty much, yeah. It boosted their total backlog, plus those reservations from 55 GW last quarter up to 62 GW now. There's some chatter, some nervousness maybe about gas turbine pricing, but management pushed back on that. They said they're actually seeing price accelerating in gas, especially in those slot deals. And they feel good about getting back to or even beating prior peak margins over the long haul.
Why the confidence on margins?
Mainly because their installed base, the fleet of turbines they service, is much larger and generates more profit now than it did during previous cycles. The service business is key.
Okay, good context. Now let's pivot to electrification, the segment where Prolec fits in. This segment sounds like it's just on fire.
It really is. I mean, orders more than doubled, up 102% organically, hit $5.1 billion just in Q3. That's incredible grid equipment demand. Revenue grew 32% organically, and the segment EBITDA margin jumped 550 basis points organically to 15.1%. Just really strong performance.
We need to talk specific drivers, though. Those numbers are huge. What's behind that 102% order growth?
Well, a couple of massive wins. They booked $1.6 billion just for synchronous condensers in Saudi Arabia.
Synchronous condensers.
Yeah.
Remind us quickly what those do. They aren't power generation, right?
No, exactly. They don't generate power. Think of them as grid stabilizers. They provide voltage support, manage reactive power, essential tech for keeping the grid stable, especially when you add lots of renewables like wind and solar, which can be intermittent.
Got it. Crucial grid hardware. And the other big driver you mentioned, the hyperscalers, data centers.
Yep. The demand there is just relentless. Orders from hyperscalers hit $400 million in Q3 alone. That brings the year-to-date total from them to $900 million. And just for perspective, they booked only $600 million from hyperscalers in all of 2024.
Wow, so the pace is really picking up.
Dramatically. And because of that, GEV raised the guidance for electrification again. They now expect organic revenue growth for the year to trend towards 25%. That's up from around 20% before. And they bumped the margin range up to 14%, 15%.
Yeah.
Okay, strong power, explosive electrification. Let's round it out with wind. That segment seems to still be facing some challenges.
It is. Yeah, wind orders were up slightly, 4% organically, but that was mostly driven by services and repowering older wind farms. The actual equipment side saw revenue decline 9% organically. Now, part of that was just a tough comparison because they had a big offshore settlement payment last Q3.
Okay, so a bit of noise in that number, but there are underlying issues too.
Right. The core challenge is that new onshore equipment orders are still soft. And that's mainly down to, well, two things. Ongoing delays in permitting new projects, especially in the U.S.
The infamous permitting bottleneck.
Exactly. It just takes a long time to get approval to build. And second, continued uncertainty around tariffs on imported components.
And those real-world delays, they have a direct impact on the outlook.
They do. Because orders are getting held up by permitting, it means less equipment will ship, and that's likely going to weigh on wind revenue into 2026. So consequently, they had to adjust the wind guidance downwards. Full-year organic revenue is now forecast down high single digits. That's worse than the down mid-single digits they expected before. And the segment EBITDA loss is now expected to be around $400 million for the year. It really highlights how policy and regulation, not just raw demand, shape the pace of the transition.
Okay, so pulling all these threads together, strong overall financials, this huge strategic bet on electrification with Prolec, but still navigating some very real headwinds in wind. What's the final takeaway message here?
I think the big message from GEV is that their potential, their growth trajectory, looks even stronger now than maybe people thought right after the spinoff. They're executing well, Q3 showed that, and they're making a very decisive capital allocation move with Prolec investing heavily in the highest growth, highest margin part of the energy transition, buying capacity, and crucially, removing that strategic barrier in North America. They're setting themselves up for the long term.
So here's maybe a final thought for you, the listener, to chew on. We see this intense, almost frantic demand right now for near-term power. Things like mobile power units, aeroderivative turbines acting as quick bridge solutions, especially for data centers needing power now. How does a company like GEV balance chasing that urgent short-term demand versus staying focused on the long-term big infrastructure plays?
That's the key strategic tension, isn't it? And GEV management seems quite clear on this. They're serving that immediate need. They sell aeroderivatives too. But they also emphasize that for their really big 20-plus year investment decisions, like a utility building a new power plant, the fundamental economics still strongly favor the efficiency of their large, heavy-duty gas turbines. So the strategy seems to be meet the immediate crunch, absolutely, but stay anchored to the long-term efficiency and economics that drive the big multi-decade infrastructure investments. That balance is really central to their story beyond, say, 2028.
A critical balancing act indeed. We'll get a much clearer view on how they see that playing out specifically for 2026 and their updated 2028 view at their investor event coming up on December 9th. Thanks for diving deep with us today.